that interesting report as promised. ICICI Securities, in its recent note, has said the growth in India's manufacturing sector is likely to be driven by products related to the Capex cycle, while general consumer products may drag. It also calls electronics manufacturing the new frontier in this space. To discuss this and more, we have the author of the note with us, Vinod Karki, Head of Strategy at ICICI Securities. Vinod, good morning. And thank you for joining in. So the note definitely got our attention, I'm sure others in the market as well. But I want to start with this. Chasing the manufacturing theme has been, I think, number one priority for a lot of fund managers, PMSs, mutual fund houses, right? We've seen this play along. And stocks have also rallied quite a bit, including in the EMS space, as you highlight, where valuations could be 50 times, 60, 70 times now. So how do you now jump onto the bus for those who haven't already?
Yeah, thanks. So, see, there is one good, if you look at past history, one thing that stands out is that manufacturing has a very good correlation with the Capex cycle or the investment cycle. So our base thesis is that the investment cycle has started to pick up, and more so from the private side, because the government was doing its bit. And the policy measures, be it the PLI scheme and the natural benefit of the China plus one, which no longer is a theory but a reality, that people have to have other manufacturing bases where they can really rely on supply. So I think all these things are playing out quite well. And we feel that apart from the traditional sectors that we have done well in the past, be it iron, steel, chemicals, pharmaceuticals and petrochemicals and those kind of products, we seeing this new frontier, which is basically the electronic manufacturing, where the base is rising quite rapidly, but we have to increase the value addition. So from doing the basic stuff like assembly and things like that, we have to get into component manufacturing and increase the value addition in the country. Other themes like defense and others are also playing out quite well. Auto is we have shown our mettle in auto manufacturing globally. So there are already, we were champions in pharma, chemicals and things like that. But these new sectors, and along with the investment cycle, the defense focus, energy, reliability, and all those things, all these factors are falling in place right now.
Vinod, morning. Reema here. The question is right now whether one can invest at these levels. There was also a note which recently came out where you're talking about the valuations, the value available in stocks. And you say the proportion of investable value stocks within the top 1,000 universe has dropped sharply to 10% versus 17% at the beginning of this calendar year. And bulk of the stocks that fulfill the criteria are related to financials, fossil fuel, energy, and materials. There are no EMS companies. There are no traditional Capex companies. So in this basket of capital goods, which you like, where is value still available right now, or should one just chase it because growth is high?
Yeah, so these are two different concepts. One where we are trying to see what is there available at cheap valuations. So as you rightly said, that space is becoming smaller and smaller. You're getting very few companies, investable companies, where the valuations are cheap. I'm not even saying reasonable. But when you start looking at reasonable valuations, which is, let's say, in the range of 20-25 times P and things like that, there are companies, and we have named them in the manufacturing report also. But some of the new frontier, as I said, the EMS manufacturing and all, they are quite expensive. So, very few to play there. So all in all, this space, the manufacturing space, has been a laggard for the whole of last decade. If you see, manufacturing as a percentage of GDP has been stagnating in the 17 to 18% for the whole of the last decade. So I think that's where, you are coming off a stagnation phase, and growth could be for a longish period of time. So I think market is jumped a little ahead of itself. But that doesn't mean that growth will not come by as we go year by year. So some of these stocks may stagnate because of the run-up, but it won't be a case that further growth won't come through in these spaces.
Okay, further growth might still come through, but maybe not at the rapid pace that we've already seen. Maybe that's what you're pointing to. But Vinod, coming on, because this entire theme is so large and so wide, manufacturing, are there certain pockets which you still feel, are a little bit undiscovered, maybe not undiscovered, but a little bit untapped into spaces like defense that you were mentioning have already rallied so hard. So do you think there are spaces that you would still feel very comfortable putting your money into?
Yeah, so I think it's a tough question actually, because market has got what you should say, the signal is there that the Capex cycle is reviving, the whole manufacturing cycle is reviving. So I don't think we're going to get any big bargains. Those times are gone basically. What one should look at from now onwards is where sustainable growth is going to come in basically. And these stocks which were earlier value now become growth stocks. So the only question is you don't pay too much for these stocks so that you get into a situation where when the growth finally starts tapering down, I don't think that's anytime soon. But you get caught in a situation where you are at a very lofty valuation.
Sure.
And growth is slowing down. But I don't think we are at that point right now. Growth will continue. So if you get something which are at reasonable valuations, cheap valuations is broadly gone, but at reasonable valuations, and you have a lot of faith on the sustainability of the growth, I think that's the space we have tried to highlight in some of the reports.
Got it. Vinod, a lot of your picks are right now flashing on the screen for our viewers, and it's a mix of stocks. You have the smaller players like a Sirma, recent entrant onto the listed market. On the EMS side, you have Havells, you have Jyoti Laboratories, and then you have the giants, the L&T, BHEL, BEL, these kind of large names when it comes to manufacturing/defense. So just leave us with the thought. I guess the trigger or the key is going to be to keep rationalizing multiples in the investors' minds as well, right? Because you need to start looking at these stocks as growth stocks, not typical old school utility/old economy stocks when the multiples were a lot lower. So we have to prepare ourselves for the next decade, if indeed it's going to be the decade of Indian manufacturing. So what valuation zones should you look at? What valuation multiples would you be, for instance, comfortable with as you've selected this whole basket? And B, is it better to be with the capital good boys like a BHEL or the big execution masters like L&T, or would you look at smaller, more niche players where perhaps the stock could do better?
So as this picks up, we have seen it in the past cycles, also 2003 to 8, when the investment cycle, manufacturing cycle really started picking up. Once you have exhausted the large caps, you start dipping into the less quality stocks, and that's finally the risk that you take with any kind of theme when it really starts building up, and the bigger ones are no longer as cheap as the smaller ones. But it's neither big nor small. You could have a small company which is building a niche for itself in terms of manufacturing in certain areas. And in that space, it may actually be the largest player. So that's how one should look at it. But don't get into weaker players. Always be with the leader, be it a small cap or a mid cap or a large cap. The cap doesn't matter. It is, do you have some kind of leadership in terms of manufacturing in that activity? So that's the key, basically.
Vinod, thank you very much for joining in. Need to get into a very short break. On the other side, we'll talk more about Nazara Tech. Here is the